Welcome back to GreenCandle. It's December 7th, 2025. We're looking at Corning, ticker GLW, trading around 84.20. You saw the thumbnail, Project Silica choke point. Everyone else is chasing NVIDIA's tail feathers at all-time highs. We're looking at the unsexy piping that actually makes the AI revolution function. Let's dive in. This is the official GreenCandle deep dive into Corning Incorporated. Forget casserole dishes and iPhone screens. It's time to reevaluate this company's DNA. We are targeting the inevitable re-rating of this stock. Look at the market right now. It's behaving like a bunch of tourists in Times Square, gawking at the same three AI chip stocks. They are completely ignoring thermodynamic reality. You cannot build a $200 billion annual AI skyscraper on 20-year-old plumbing. The build-out is hitting a brick wall, a physical one. It's not silicon, it's optics. The street still sees Corning as a boring legacy manufacturer. We view it as the undisputed wide moat choke point for the entire AI economy. We're positioning for the pivot from cyclical industrial dinosaur to critical AI infrastructure. Here is the physics headache keeping hyperscalers like Google and Microsoft up at night. They need to connect thousands of GPUs to train massive models. Traditional copper cables? Forget it. They can't handle the speed or distance. The signal loss is too high. They need fiber. But here's the rub. They don't just need more fiber. They're running out of physical real estate in their data center conduits. They need radically denser fiber. They need to stuff 40% more capacity into the same footprint yesterday. We call this the density wall, and it's the primary bottleneck for scaling AI compute. This is the easiest mistake retail investors make, assuming glass is just a commodity. It is not. Corning has a 170-year head start in material science IP. Their proprietary fusion draw process creates glass of unrivaled purity and strength. It's incredibly capital intensive and scientifically near impossible to replicate. They are the #1 global fiber producer and the lowest cost producer thanks to massive vertical integration. Morningstar rates this a wide moat for a reason. Competitors can't hold a candle to their scale or their tech. That moat is powering their ignition sequence, the optical communication segment, or OCI. This is the mainline vein into AI capex. The data proves it. In early 2025 reports, enterprise data center sales in this segment surged a massive 106%. Their high-density solutions like Rocket Ribbon, packing nearly 600 fibers into a tiny footprint, are becoming the industry standard for new AI builds. They aren't just selling glass, they're selling the only viable architecture for next-gen data centers. This engine is driving a $3 billion plus revenue potential in their 2026 plan. Corning isn't just talking a big game about growth, they're executing a financial U-turn right now. Post-COVID, high inflation ate their lunch. But now, pricing power has been restored with a vengeance. Q3 gross margins expanded a full 100 basis points to 41% thanks to efficiencies and strategic price hikes. And here's the kicker. As high-margin AI fiber becomes a bigger slice of the revenue pie, those margins have plenty of room to run, driving disproportionate earnings growth. They have the financial biceps to fund this massive growth cycle without loading up on risky debt in a 4.5% rate environment. They are a cash flow machine. Free cash flow YTD is up 15% to $800 million. They're sitting on a $1.5 billion cash pile, up 5%. The point is, they are self-funding new capacity expansion in North Carolina and Texas just to meet the hyperscaler demand. If AI was the only story here, it would be enough. But it's not. They have multiple secular tailwinds at their back. First, the 5G and 6G reality check. Global 5G connections just hit 2 billion, up 30% year over year. Every new tower needs fiber backhaul. Second, the clean energy pivot. They're providing specialized glass for solar panels and developing ceramic covers for next-gen EV batteries in partnership with QuantumScape. In this environment, you always want the government on your side of the trade. The Inflation Reduction Act provides massive 45x tax credits, up to 30%, for domestic manufacturing of their solar and EV components. That is essentially a government-subsidized margin floor. Worried about Trump's 40% tariffs on China glass? Don't be. Corning makes 80% of its stuff domestically in the U.S. Tariffs hurt the competition. They help Corning. This is the core GreenCandle thesis. The market is mathematically out to lunch. Right now, GLW trades at about 25 times forward earnings. That is a low-growth industrial multiple. Look at pure-play AI infrastructure stocks like Arista Networks or Vertiv. They trade at 35 to 40 times. We are buying that arbitrage. Analyst consensus targets already average $95 with highs at $110. As EPS climbs past $3 on AI margin expansion, a simple re-rating to a 30x multiple puts this stock well over $110. We don't ignore risks here. We quantify them. What's the bear case? Risk 1. The China display glut. TV glass is cyclical and facing oversupply. The mitigant? Display is now only about a quarter of revenue. It's just a cash cow used to fund the AI fiber growth engine. Risk 2. Insider selling. Execs sold over $10 million in November. The mitigant? The stock is up 25% YTD. Executives diversify. The structural trend is bigger than a few insider sales receipts. The chart confirms the fundamental thesis. The stock is coiling like a spring. As of December 6th, GLW is trading around 84.20, consolidating just below its November highs of 88.50. It's forming a classic ascending triangle pattern, higher lows pushing up against flat resistance at $88. This is bullish energy building up. The stock is holding firmly above its 50-day EMA around 82. A decisive breakout above 88 triggers a measured move target of 95 to 97 in the near term. Disclaimer time. I'm just a guy on YouTube with a microphone and too much coffee. This isn't financial advice. It's financial amusement. Please don't bet your life savings based on my cartoons. Do your own research and try not to do anything that would make your grandma disappointed in you. All right, enough talk. Stop gambling on hype and start executing calculated bets based on structural data. Here is the game plan. First, the investor. This is a long-term compounder. The technicals are bullish. We recommend continuous dollar-cost averaging. Nibble on pullbacks toward the 50-day EMA around 82.32. If we get a deep flush to long-term support at the 200-day near $67, back up the truck. Hold for the 18 to 24-month re-rating to 110 plus. Second, the trader. Wait for the whites of their eyes. The stock is coiling. Look for a confirmed closing break above $85.50, or ideally the $88 major resistance before entering bull call spreads to play the breakout with defined risk. Here's the tactical example. You buy an $85 strike call, getting you in near the money. Simultaneously, you sell a higher $95 strike call against it. We'd look at a January 2026 expiration to capture that earnings catalyst. By selling that top call, you cap your profit beyond $95, but you significantly lower your upfront cost and define your exact maximum risk on day one. Third, the income generator. This strategy is perfect right now. We know there's massive institutional support between 80 and 82 bucks. The play is to sell cash-secured puts at the $80 strike for January or February. You collect cash premium up front. You are essentially getting paid to set a limit order at major support. Just keep a hard stop loss on a weekly close below 80 to stay disciplined. That's the deep dive on Corning. The plumbing of the AI revolution is unsexy, overlooked, and undervalues. Just how we like it. If you appreciate structural alpha over hype, smash that like button and subscribe so you don't miss the next one. Stay rational. GreenCandle out.